Good afternoon. My name is John Winnick, President and CEO of Cloutier Capital Management. We are here with the President and CEO of MidSouth Bancorp and MidSouth Bank, Rusty Cloutier. Rusty, thank you for joining us today.
Oh, my pleasure, my pleasure. Always glad to be with you.
Great. So first, just going to talk a little bit about MidSouth Bank, talk a little about your markets. We'll talk a little bit about the regulatory environment, as well as some of your thoughts on the overall banking industry. First off, tell us a little bit about the markets that you guys serve, and kind of give me your, real-world outlook for how those markets are doing.
Well, we're in the energy corridor. We handle all of South Louisiana, Northwest Louisiana, over into Texas, Dallas, Houston, College Station, Conroe. We're we're one of the largest energy banks in America. And, energy is very good right now. We're learning how to become more self-sufficient in energy and, not being as dependent on foreign oil. So our economy has been very good, very, very much above the norm, I think, of the country.
And your market would be, just for the benefit of everybody, you're basically Lafayette towards Texas?
Baton Rouge, everything along the coast with the exception of New Orleans, all the way to North Louisiana, up to Shreveport, and then over in Texarkana, and all of basically East Texas. So Houston, Dallas, we just opened a loan production office in Austin. So, most of the area we cover pretty well.
Now, you stayed out of New Orleans. Is that any plans to enter that market, or?
No plans at all to enter that market.
Nate, so let's talk about the energy industry. Certainly in the past, it's gone through a lot of boom and bust cycles. How is it different now? And what have folks in the industry, from the lending side to the operator side, learned to kind of prevent the ups and downs?
Well, I think the big difference now is we have an administration that really wants us out the Middle East very badly. And the only way to get out the Middle East is internal energy production. So I do believe we will continue to see a lot of that going forward. And, I just believe that we will continue to have an improved energy environment in the United States. So, we're very optimistic, very, very hopeful that continues, because we cannot get energy out of the Middle East without troops on the ground.
And what type of businesses are you serving? You obviously do a lot of lending in that space. What are your kind of typical customers? Mainly
oil field service companies, companies who service the bigger companies like Exxon, Texaco, type situation. Those are the ones that we service more than any others.
Gotcha. Now, your region has been impacted by both natural disasters, Katrina, and man-made oil spill. Now several years past these events, how have these two events impacted your region and today?
Well, Katrina definitely was a failure of the United States government. There's no question about that. It wasn't a storm. It was a failure of the government, the Corps of Engineers, to be able to do their job, because that was really the disaster. That's what flooded New Orleans, was the levee's fault, failing, and the Corps not doing their job. To be honest, Rita that year was probably a worse hurricane as far as strength of hurricane and damage and whatever. So, how that's affected us is, the Corps swears this time they're going to do it right, and they're going to fulfill their jobs and do them right this time, and we certainly hope that does happen. We're also seeing some big increases in flood insurance costs. I think that was more out of Sandy than it was out of Katrina and Rita. You got to remember that the congressmen have very little gumption to be able to vote against someone, and so they continue to allocate all this money for all these disasters that the country don't have to pay. And so it's been a very, very difficult situation for them. But, Katrina is well behind us now. That was 8 years ago, and I would say there are no long-lasting effects on that. On the other subject of the BP oil spill, there were some technical problems that BP made that shouldn't have happened. I think those have pretty much been corrected. The worst part about the BP oil spill, again, was the government's misreaction to what happened. Obama shutting down the Gulf for a year. We lost a year of production, which the American people are still paying for because, prices went up and they never came back down. So, but I think also we're pretty much past that, and we can hopefully move on, being able to continue to increase production. We're seeing a lot of that situation coming together. So we're pretty optimistic about that. Not only offshore, but the Balkan, the Gulf, Eagle Ford Shale, the Bentonville, the Haynesville, and Marcellus. I mean, they're discovering all over the United States, oil and gas, and that's going to be critical to our future. That's the one thing that could save the country. If it wasn't for cheap energy right now, God only knows what we would do in this country, because with the massive deficits we got and the problems we are facing, even with zero interest rates over the last 5 years, they hadn't been able to get the economy restarted. And the only thing that's been able to help it and save it right now is very, very cheap energy costs. So,
well, I read the 2009 profile in the New York Times that you were looking for loans.
right.
I was looking at your loan-to-deposit ratios. Still probably you'd like to see more loans, I'm sure. Has it been difficult finding good loans, and what's been the biggest impediment?
Well, man, I'm going to sound like a broken record here, but the biggest impediment has been the U.S. government. The customers are still very leery of investing. They do not trust the government. Every time they think they've got some control on them, somebody introduces another bill in Washington that scares them to death, like the one that the senator from New York, the lady, introduced to, give people paid time off now for family medical leave. It sounds great, but how in the world are you supposed to run a business if somebody can take 24 weeks a year off and they're going to get paid for it? So it's just a difficult environment. My customers are very, very nervous. They live in a very nervous atmosphere of what the government's going to do to them next, Obamacare and whatever. But we're hoping that, we see some improvement in that over the next couple of years, that it straightens out, and that now that, the Obama administration, and I don't say this negatively towards them, but any last 2 years of any administration that's been in power has not went very well. I don't care if you want to go back to Eisenhower, Nixon, Bush, Reagan, pick any of them. It's been a real challenge for them. So that might be positive, and you might get people in a better mood to spend money, but that's been a real problem. Just too much thought about the government's going to do this and the government's going to do that to them, and they're very, very nervous about that. So anyway, that's kind of where we are there. But, we're starting to feel people's moods getting a little bit better, but not as much as I would like. They're still not optimistic. We still have a lot of businesses talking about selling out rather than staying in the business.
Well, I read that same 2009 article. You made a comment. If a guy owes you $7 or $8 million, you better know everything there is to know about him.
Right.
Talk to me a little bit about how a community bank differentiates itself and kind of understanding its customers. Talk to me a little bit about how that contrasts with more larger institutions that don't offer.
Yeah, well, a large institution, and nothing against them, I do think they have a place in the world, and I think they do have an existence and a reason for being here, but they are not a competitive force against a community bank that is trying to deal with the small customers that we deal with on a daily basis. I mean, it's just that's not their model, and they're pretty honest that they want to deal with the international credits, their trading desks and their swap floors and whatever, where, it has been this way for years that the actual purveyor of small business loans has always been the community bank. And so I think that just continues, and I think it will continue for a long, long period of time. So I just think that's our business model. That is not their business model, and I don't mean that negatively. Everybody's got a business model. I was chairman of ICBA about 10 years ago, and the one thing I've learned, and I learned extremely well, is that there was at that time about 5,000-6,000 banking companies around America, and every one had a different banking strategy. That doesn't mean one was good and one was bad. And, I don't want to sit here and say, well, MidSouth's got the perfect strategy and everybody else in the world has a bad strategy. That's not the case. But my strategy and the strategy being implied by the 5 largest banks in America are totally different. Because I tell people, they're playing in the NFL and I'm coaching junior high football. And, junior high is a lot more hands-on than when you're playing in the NFL. They don't figure they got to teach you any basics. We still dealing with the basic customer that maybe has 5 employees and, trying to run a good small business, and we're trying to help him. So that's the major difference.
On that note, I did notice that you did take advantage of the SBLF program.
Correct, yeah.
I think you took $32 million in capital. What are your thoughts have been on that program? I think it's a couple of years into it.
Well, we've done extremely well. Matter of fact, we're closing out today. We will hit our numbers to keep our rate at 1% for the next 2.5 years. But we were able to get all our money out to the community. We are very proud of the work we've done there. Of course, that bill was originally sponsored by our U.S. Senator, Mary Landrieu. So we had agreed at her request to participate early on and to try to be one of her star performers, and we think we've done that. We've got out almost $70 million, I think was the last number I saw, the small business loans we made with that $32 million. So we definitely got the money, out to our customers, and that was the intent in trying to stimulate this economy somewhat, because it is very, very challenged, this economy, as I said earlier. So we're just trying to see what we can do to help it, and certainly we thought it was a good program to help out some of our customers.
On the M&A front, are you folks currently looking? Any markets?
Well, we're always looking, and we continue to look. We love what we got right now, though. I've got to be very honest. We love our footprint, where we are, the markets we're in. We think we're in a very, very high-end area. We like the demographics of what we got. And so, we're really trying to develop what we got. It doesn't mean we're not willing to talk to somebody else or work with somebody else or try to do a merger. But we really love the footprints we got and what we got going on. So we're always looking, but we also of the opinion that if we don't get anything over the next year or so and we can't work something out, because we do think prices have fallen. The number of branches you're going to need to market an area is not what it used to be, and we do feel like some of that is come down. So we're continuing to look, but we look with a very careful eye from that standpoint.
Well, I noticed that your bank does have separation between the CEO and chairman.
Thoughts on that?
Well, I've always worked that way. I always think it's good. I always have thought it was good. I don't really disagree with somebody that thinks they want to do it another way, because I can understand. As I said earlier, when I was with ICBA, I learned there are 4,000 ways to run a bank. It doesn't mean one's right and one's wrong. I've always liked it because I've got somebody who deals with the board, which is a big issue for a lot of companies, presidents who have to deal with the board too. I just think it's made it more convenient to me. We like the model. Me and my chairman have been together a very long time, and I think it's been more supportive and helpful for us to be able to run the bank by having an outside chairman be able to give some thought process and some opinions on what he thought was helpful, and also to give me good feedback from the board, and the board not being concerned about, well, I don't know if I really want to go tell Rusty this, and give them an opportunity to bounce it off of somebody else. So I think it's worked real well. Now, that doesn't mean that other models wouldn't work, but I'm one that really believes in you should have more shared leadership than less. I think in the long run it pays dividends for you.
Well, I noticed you added Jake Delholm to your board.
Yes.
Yeah, I thought that was interesting because it seems like on the one hand, it does look like the banking industry is becoming so complex that it's harder and harder to bring outsiders, if you will, up to speed on what's going on. It sounds like a lot of community banks do want to get people that are active in the community on their board. At the same time, it seems like you got to go to banking school now to be a board member.
Yeah, well, we were very, very blessed. I mean, Jake is a gift from heaven. First of all, he is a very determined young man. I don't know how much you know about the Jake Delhomme story, but he was told no more times than you can imagine by various organizations. And he was not drafted, and he played 17 years in the NFL. One of only 32 quarterbacks to make it to the Super Bowl. So he's got a lot of determination. The second thing is he's fairly young, and getting some youth in the group is very, very important, because you also have a different society below the age of 40 and above the age of 40. As we call them, the texting iPhone generation, and those of us that were raised with house phones, and hell, I was raised with black and white TV. Okay, so get a little difference. The other thing we loved about Jake is, having been a quarterback in the NFL, there is no job tougher that you have to study for and be able to handle than being an NFL quarterback. I mean, you cannot imagine how much time is put in by those guys that play quarterback in the NFL to prepare for a game. As an example, Drew Brees in New Orleans, or Peyton Manning, or whatever. Great deal of intelligence, great deal of being able to read things and understand what is important and what isn't important. And the other thing is being used to making a decision and sticking by it. And if you make the wrong decision, as Jake says, if you throw a touchdown or you throw an interception, you got to forget about it immediately and move on. Okay? And it's the same thing here. You got to learn Dodd-Frank and get used to it. And if you don't like it, that's fine. But it's still a law of the land. So, you got to move on to the next thing, understand what happened, and move on. So Jake is a very smart young man, also, now retired. And you just don't find a lot of 39-year-olds 38, 39, he'll be 39 pretty soon, who are independently wealthy, made it all on their own, and willing to get involved with the bank. So we are very, very pleased to pick him up. We think it's a huge addition and something we're really ecstatic about.
Sounds like it. Switching gears to the regulatory environment, let's just start with the most organic question.
I know you wrote a book that kind of covered this, but talk to me about, in your view, what caused the financial crisis.
Greed and corruption, as I wrote in my book. It's not real complicated. A lot of greedy people who don't have to be responsible for their actions. Too big to jail, too big to fail, too big for everything. And, a real problem. And unfortunately, that's just the way it was, and that's still the way it is today. I mean, you've got these companies that do unbelievable stuff and basically get away with it. I mean, I hate to use that term, get away with it, but they basically do. And, what was it, last week, we had a situation to where one bank, in a matter of 12 hours, paid $1.3 billion in fines, and talking about paying another $11 billion. So you got some situations that we having trouble to deal with in the country. Hopefully, we will deal with them soon and get all that straightened out. But look, I wrote about a lot in my book. It is very clear that we should immediately say, if you're a systemic risk, we clean up that systemic risk and get rid of it. Nobody can give me an argument for leaving companies that are systemically risky still available to be in the business. I just don't buy any thought process on that.
Well, you talked about that. You talked about limiting the size of banks to $500 billion. Could you elaborate on that? And the argument against that is, does that hurt these banks relative to their foreign peers from a competitive standpoint?
Well, I love that those comments about, well, we're not going to be able to compete with the foreign banks. And I'm like, okay, which ones? Because they all broke. Okay? I mean, just go look at the foreign banking. That's why they're having all those crises in all those foreign countries. That's a very, very weak argument. Plus, large banks for years have done syndicated credits. So they easily could do syndicated credits if they had a company that big that needed that much money. And I'm not opposed, I put $500 billion because that's the number I've always heard. I don't have a problem with what the number is. Just there's no reason that me and you and everybody else as a U.S. taxpayer should be liable if they fail. And that's where we still are. And so, I think that's a critical problem, from this standpoint. So, I mean, if you're systemically risky, it'd be like you going to the doctor and saying, okay, you have cancer, and you say, okay, I'll wait and see if it really gets bad. That doesn't make any sense. And same thing with systemically risky. If you have a problem and you know you got a problem, then I think you ought to deal with it. I don't think you ought to put it on hold.
Sure. So what you're saying is banks would be required to divest themselves below whatever that threshold is?
Yeah, I think you give it to each bank to decide what they want to do. They may want to get out of some businesses they're in. And once again, you got to determine if it's systemically risky. I mean, it may be a bank that, is $1 trillion and it's not systemically risky because they're doing nothing that makes them systemically risky, and I'm okay with that. I don't have a problem with that. But if you say, that this is the reason that this is going to happen, and I mean, systemically risky means that the country could fail if that company fails. I don't think we should ever put ourselves in that position. And then I think you give them time to become unsubstantially risky. I mean, would you do something that you knew was in danger to your health? If you went to the doctor and he said, if you keep eating broccoli, you're going to die in 6 months, would you eat broccoli again? I doubt it. So if you know something let's move ahead and, you know what I'm saying? We improve where we are.
Well, it's been about 5 years from when Lehman Brothers failed. Do you think, as a banking industry expert and a commentator, have we learned from our mistakes, or are we kind of doomed to repeat the same mistakes that caused the last blow-up?
Well, you know, I was kind of a little bit amazed. Both USA Today about 2 weeks ago and Time Magazine last week both wrote big articles, and you know, both very well done, and both said we exactly where we were before. And you know, it not only could happen again, they believe it will happen again. They believe there are just too many systemically risky institutions out there that the book that none of them are going to blow up is just hard to believe. You know. So, you know, I think they're most probably correct. When you got that many institutions that could blow up, one of them may, and if one of them does, it could bring down the whole system, is a very scary thought.
Why do you think it's taken so long for Dodd-Frank to be implemented, and how is that disrupting the marketplace?
You know, what has happened, I have a good friend, and I love this quote, they get the gain and we get the pain. Dodd-Frank was a bill written that really helped the big banks out quite a bit. It brought a lot of pain and suffering to other banks, but it really didn't deal with the one problem they were supposed to deal with, and that's being systemically risky. So, you know, we ended up with you know, a bill that was about the same as where they were before, and they keep saying, well, we hadn't implemented this, we hadn't implemented that. My opinion from a guy living in Louisiana who's seen a little politics in his life, if you haven't implemented something in 5 years, you have no plans of implementing it. So, you know, it's like making a statement, well, we have a committee that's going to study that issue. When a politician tells me I have a committee that's going to study that issue, that means to me it ain't never nothing going to be done about it. Okay? It's a nice way out the back door. So, you know, I don't really think there's a real will right now to do it. I think there will become a will, as there was with you got to have another HSBC crisis or something like that come about, and then I think you may see the will. But the problem is the country has so many problems right now that they can't focus on the banking system, and that's positive for those that are violating the law because they can continue to get away with it, because you got Syria, you got the Middle East, you got the budget crisis, you got the spending limit crisis. So it's hard among all that fog to get up there and say, look, let's talk about the banking situation, and you won't until you get another crisis.
I saw from your bio that you were past chairman of the National Advisory Committee of Fannie Mae.
Right. That's correct.
What are your thoughts on GSE reform?
You know, everybody wants to talk about it, but the problem is I'm not sure anybody really wants to deal with it. It sounds nice to say, well, let's go have reform, okay? And I'm all for that. I'm not against it, but you know, it's who wants to do away with cheap housing in the United States of America? That's what we have. We're the only country in the world that the government subsidizes housing. It has been a long-term plan ever since World War II that the government subsidizes home buyers. We are one of the few countries in the world with a 30-year mortgage. We give tax breaks for home ownership. And don't get me wrong, I'm not telling you I want to do away with any of that. I'm just telling you all that's on the table. And it's easy to go stand up and say, man, I'm really against, you know, Fannie Mae or Freddie Mac, but it is very difficult for them to go deal with it. And I think the same thing you're looking at right now across the board for them to want to deal with what they consider very, very tough problems. And then remember, Fannie Mae was their hero just 6 months ago because the budget crisis is now front and center. Should have happened 6 months ago, except Fannie Mae made so much money in the first and second quarter that the government got all that money back, and it was able to keep running the government off of Fannie and Freddie's money. So, you know, it's always a very difficult situation. It is easy to say, to quote Nick Saban, it's easy to say what plays I didn't run that was right, but it's much more difficult for you to plan the game plan and you go run it. Okay? And what I mean by that is it's easy for people to sit back and say, well, we ought to cut this and we ought to cut that. And then you ask them, well, okay, you want to cut housing in America and you want to make it very difficult for a young person to get a house. You want to make it only 15-year loans. You want to reduce the subsidy on home lending. And they go, oh, no, that's not what I meant. I meant do something about Fannie and Freddie, you know. So anyway, that's where we are, you know. So
do you think continued government involvement in housing is inevitable, that GSE reform will be limited in scope?
Absolutely. Look, none of these people that get elected to Washington, I'm not being critical of them, I'm just being blunt, is real interested in go and take the real heat that would take from, you know, ending these situations. So I think you'll have some things going around. I think they'll tighten up the standards some, but you know, I don't see no reform on that. I mean, I can give you another instance, another bank product is student loans. I mean, you know, we know the default rate and whatever we have in this country on that, but I don't see them making any radical changes to that program anytime soon either, even though they know that it is somewhat of a nightmare, you know, if you understand what I'm
saying. I took interest from the panel a couple of weeks ago where you mentioned that you were one of the few bankers that has had all 5 Camel ratings.
I don't know if I should be proud of that or upset about that.
Just describe your different experiences, you know, and having some issues in the 90s to today, kind of being, you know, in the good graces and the bad graces of the regulators.
Well, you know, I mean, in the 80s, you know, we had one hell of a depression when everybody decided we didn't need oil and gas again. If they would have stayed the path, we'd most probably be better off as a country. But, you know, look, they made a decision to depend on the Middle East, and it cost tons of lives after the late 70s, early 80s, and we got cheap energy out of that. Well, it created the economies we were in. I wrote about in my book, you know, for 6-7 years. And yes, my bank did get all the way down to 2.4% capital, basically a 5 rating. They told us they were going to close and whatever. That was very, very difficult times, but I learned a lot. I learned a lot that could never be replaced by being told about it. And, you know, today's environment, I think there's a lot of bankers taking more risk than I would take. The one thing I learned back coming out of the 80s is the most dangerous loan you can make is a real estate loan. And you don't realize how difficult it can be to move a real estate loan if it goes bad on you. It don't mean that you shouldn't make real estate loans. It just means that if things turn sour on you, as happened in Florida and Georgia in the last couple of years, how difficult it can be to get out of that. And how you will be pursued heavily by the regulators, and that, you know, as a regulator told me one day, just remember, you're not too big to fail. And if you're not too big to fail, you're not above prosecution. So it's humbled me in a lot of ways, and it's made me very cognizant every day of making sure we don't get in trouble again, you know, from that standpoint.
Well, you talked about a gotcha mentality today.
Mm-hmm.
Please expand on that.
Well, you know, back in my early part of the career, And I don't blame the regulators totally for this. This is our politics, very bad situation in America, by the two parties always saying, I got you. But, in the early part of my career, regulators would come in and they'd say, look, you made this mistake and, hope you can rectify it. We'll come back in 6 months and check and see if you got it cleaned up and whatever. I think that's a different environment today. You got the CBO all over them, the regulators, monitoring everything they do. And if it looks like they gave anybody a break, the CBO and Congress is going to play, I got you, you shouldn't have done it. And so that brings them into an attitude of, well, if we find something, we got to write you up right away. There is no more, well, let us work with you, let us see what can happen. So I think in the country it's more of a I got you mentality, than it is saying, let me work with you some and let me see if we can work together to improve it, So much more difficult environment than I've ever worked in or I've ever seen in my career. And I don't think it's going to get any easier. I think that's why you have the lowest number of banks you've ever had in the country today, and that number will continue to fall.
Do you think we're headed towards fewer banks with the consolidation, getting down to some people have suggested 2,500 is the number we could end up with?
Well, I don't like to throw out a number. I mean, I've heard 2,500. I've heard 4,000. The one thing I can promise you is every day my iPhone sends me 2 or 3 bank mergers, and there are no new banks being formed. So if there's no new banks and they're merging 2 or 3 a day, it doesn't take a genius to figure out we're going to continue to get to a smaller number every day.
Sure. What are your thoughts on the future of branches?
We had a big meeting on that this morning. I think the old days of being a very dense branch network in an area is going to die off. I still believe the branch will always be important. I think it'll be important 15, 20 years from now. But I think the number of branches, the number of people in branches may die off. I think you've already seen the larger institutions start to thin out their branches, not exit any markets. I've seen a couple of them exit a market, but mainly saying, okay, I've got 21 branches in this area, and I could do it very well with 15. And so I think you're going to continue to see that, and you're going to continue to see automation. The customer wants automation. The customer wants to be able to do banking on their iPhone, their iPad, call a call center, and from that standpoint. So the customer is driving this a great deal, and everybody better listen to the customer. They still want the branch to go in if they got a problem, but it's more of a safety net than it is their primary driver of business.
There are a lot of forces out there that are unfavorable to community banks, from the increased regulation to people shifting towards activities online, to the just natural tendency of a need to get bigger and bigger. How do community banks stay competitive in this environment?
I think they've got to continue to work on it. I think you got to work on it every day. I think you got to see how you can get more business, how you can be more efficient, how you can move ahead and do a better job every day. This is not your father's bank. This is definitely not your grandfather's bank. It's a different environment. You got to be very entrepreneurial in spirit, and you got to raise the questions often. Is this really what I want to do? Because there's a lot more work than it used to be. Banking used to be a pretty easy business. I don't think it's that easy anymore. So that's where we are. It's a challenge.
I was looking at some industry data of one of the research companies put out analysis of the 1,500 or so publicly traded banks. It was interesting that banks, the larger they were, the more profitable they were. until at around $1 billion to $5 billion, and then the benefits of scale seem to peter out after you got over $1 billion. What are your thoughts on the ideal bank size, given the increased regulatory step-ups at $10 billion, $15 billion, $50 billion, and so on?
Well, you know, I think what you got to do is you got to go through a number. You cannot putt around a number. In other words, if you can be over $1 billion, I think that's the first break. You got to get well over $1 billion because there's too much cost to being just $1 billion bank. That makes no sense. Same thing in $10 billion, and I've had a lot of talk with a lot of my friends that are $7, $8 billion. If you're going over $10 billion, you better go to 15 to 16 to pay for all the additional stuff you got to pay for. The same thing I hear about 50. If you're going to be over 50 billion, then you better be 60 or 75 billion. So, you know, the ideal size is, you know, about 50% above what that cutoff number is. So, you know, you got to figure if you want to go play in that league, and let's again say, let's take it elementary school, junior high school, college, and pro football. Let's use those 5 as an example. If you want to step into the next league, you better really be in the league, not a little bit, but serious. And the higher you go up, the more you have to be willing to work and the challenges you have to be willing to accept, because the people who are giving you money are less forgiving than they are at the lower level. And let me explain that to you. If you got a community bank that's $200 million and all the stock is owned in the bank, and it's all the families, you might be able to get by with a 7% return and everybody in the community is happy and they love their local community bank. But as you become more and more publicly traded and you become bigger, I don't think anybody's going to accept a 7% return from the largest companies in America as a good investment, and institutional investors continue to put money into them.
All right. Well, that's all the questions I have. Rusty, this has been terrific. Thank you so much for your time this afternoon, and we look forward to hearing from you in the future.
I look forward to you. Thank you so much for doing this with me. I hope I've answered your questions honestly and directly, and, you know, did what I wanted to do, you know. So.